Introduction to Business, 2nd edition, an OpenStax textbook. Read along with the full text at openstax.org. This audiobook was produced by Open Audio. Listen for free on Spotify, YouTube, Apple Podcasts, or on our website at openaudio.us.
Chapter 4. Forms of Business Ownership. Introduction.
Learning outcomes. After reading this chapter, you should be able to answer these questions. 1. What are the advantages and disadvantages of the sole proprietorship form of business organization? 2. What are the advantages of operating as a partnership, and what downside risks should partners consider? 3. How does the corporate structure provide advantages and disadvantages to a company? And what are the major types of corporations? 4. What other options for business organization does a company have in addition to sole proprietorships, partnerships, and corporations? 5. What makes franchising an appropriate form of organization for some types of business, and why does it continue to grow in importance? 6. Why are mergers and acquisitions important to a company's overall growth? 7. What current trends will affect the business organizations of the future?
Exploring Business Careers. Jessica McLean, Sole Proprietor. In most any elementary school classroom, at least one child's answer to the question, "What do you want to be when you grow up?" will be a lawyer. One of the most popular careers, lawyers are powerful figures in society, shaping our laws and ensuring that we adhere to them. Their prominence and power have led to the stereotype of rich, career-driven lawyers, often leaving no room in our minds for those who truly want to bring justice to the world. However, Jessica McLean, a lawyer focusing primarily on women's rights, is quick to say that, as with many stereotypes, that is only one side of the story. I know because I lived that. I was on my way to being a successful corporate lawyer, but I realized what I was doing and how different that was from why I'd started practicing. So I walked away from it all to start my own practice. Nervous about the prospect of private practice, she has chosen to operate as a sole proprietorship for now. Sole proprietorships are easy to set up for people who want to work on their own, prefer direct control of the business, and desire the flexibility to sell the business or close the doors at any time. For me, it's the best choice because I am not responsible for or to anyone else. I can easily dissolve the business if I find it is not proceeding how I'd planned. More positively, too, if it does succeed, I know that success is due to my hard work. Indeed, McLean's law career was not always in corporate law. She turned her sights toward law after a gender and communications professor at DePaul University suggested her argumentative style might be an asset in that profession. She said I needed to tone it down for class, that the other students seemed afraid to speak up, but then asked if I'd ever considered being a lawyer. McLean, who had always been interested in issues of justice and legality surrounding women, took her professor's advice and made the leap into law. While in law school, she clerked for the city of Chicago in their Department of Personnel's Sexual Harassment Office and volunteered for the Cook County State's Attorney's Office in the Domestic Violence Division. The cases she worked on were emotionally trying. Despite the difficulty of the cases, she was drawn to them, compelled by the people she helped and the change she was able to effect. After school, she continued in related practice, working first for the Cook County State's Attorney's Office. After several years with the State's Attorney's Office, she needed a change. It was then that McLean decided to work for a corporation, a form of business that you will learn about in this chapter. Why did I switch to corporate law? I think I was burnt out to some extent. It's so hard to work on those cases day after day. I needed to see if I would be better somewhere else. Having enjoyed the rewards of working with the state's attorney's office and a corporation, and being a sole proprietor, in 2014 McLean joined a limited liability partnership firm in Chicago, an LLP, which is a form of business that you will learn about in this chapter. As her needs changed, the form and type of business organization she has worked for has changed also.
This chapter discusses sole proprietorships, as well as several other forms of business ownership, including partnerships and corporations, and compares the advantages and disadvantages of each. With a good idea and some cash in hand, you decide to start a business. But before you get going, you need to ask yourself some questions that will help you decide what form of business organization will best suit your needs. Would you prefer to go it alone as a sole proprietorship, or do you want others to share your burdens and challenges in a partnership? Or, with the limited liability protection of a corporation, or perhaps the flexibility of a limited liability company, LLC, make more sense? There are other questions you need to consider too. Will you need financing? How easy will it be to obtain? Will you attract employees? How will the business be taxed? And who will be liable for the company's debts? If you choose to share ownership with others, how much operating control would they want? And what costs would be associated with that? Sole proprietorships are the most popular form of business ownership, accounting for about 3/4 of all businesses, compared with around 10% for partnerships and under 20% for corporations. Because most sole proprietorships and partnerships remain small, corporations generate the vast majority of total business revenues and more than half of total profits. Most startup businesses select one of these major ownership forms. In the following pages, we will discover the advantages and disadvantages of each form of business ownership and the factors that may make it necessary to change from one form of organization to another as the needs of the business change. As a company expands from small to mid-size or larger, the form of business structure selected in the beginning may no longer be appropriate.
.1 Going it alone. Sole proprietorships. Learning objective. What are the advantages and disadvantages of the sole proprietorship form of business organization?
Jeremy Shepard was working full-time for an airline when, at the age of 22, he wandered into an exotic pearl market in China, searching for a gift for his girlfriend. The strand of pearls he handpicked by instinct was later valued by a jeweler back in the States at 20 times what he paid for it. Jeremy cashed his next paycheck and hurried back to Asia, buying every pearl he could afford. Founded in 1996, his company Pearl Paradise was brought online in 2000. Shepard chose the sole proprietorship form of business organization, a business that is established, owned, operated, and often financed by one person, because it was the easiest to set up. He did not want partners, and low liability exposure made incorporating unnecessary. Fluent in Mandarin Chinese, Japanese, and Spanish, and immersed in Asian culture, Shepard believed the internet was the way to market his pearls. Pearl Paradise is a leading online pearl retailer based in Los Angeles, with an appointment-only showroom and a growing live stream sales program that showcases farm direct and one-of-a-kind pieces. Advantages of sole proprietorships. Sole proprietorships have several advantages that make them popular. Easy and inexpensive to form. Sole proprietorships have few legal requirements, local licenses and permits, and are not expensive to form, making them the business organization of choice for many small companies and startups. Profits all go to the owner. The owner of a sole proprietorship obtains the startup funds and gets all the profits earned by the business. The more efficiently the firm operates, the higher the company's profitability. Direct control of the business. All business decisions are made by the sole proprietorship owner without having to consult anyone else. Freedom from government regulation. Sole proprietorships have more freedom than other forms of business with respect to government controls. No special taxation. Sole proprietorships do not pay special franchise or corporate taxes. Profits are taxed as personal income as reported on the owner's individual tax return. Ease of dissolution. With no co-owners or partners, the sole proprietor can sell the business or close the doors at any time, making this form of business organization an ideal way to test a new business idea. Disadvantages of sole proprietorships. Along with the freedom to operate the business as they wish, sole proprietors face several disadvantages. Unlimited liability. From a legal standpoint, the sole proprietor and the company are one and the same, making the business owner personally responsible for all debts the company incurs, even if they exceed the company's value. The owner may need to sell other personal property, their car, home, or other investments to satisfy claims against the business. Difficulty raising capital. Business assets are unprotected against claims of personal creditors, so business lenders view sole proprietorships as high risk due to the owner's unlimited liability. Owners must often use personal funds, borrowing on credit cards, second mortgaging their homes, or selling investments, to finance their business. Expansion plans can also be affected by an inability to raise additional funding. Limited managerial expertise. The success of a sole proprietorship rests solely with the skills and talents of the owner, who must wear many different hats and make all decisions. Owners are often not equally skilled in all areas of running a business. A graphic designer may be a wonderful artist, but not know bookkeeping, how to manage production, or how to market their work. Trouble finding qualified employees. Sole proprietors often cannot offer the same pay, fringe benefits, and advancement as larger companies, making them less attractive to employees seeking the most favorable employment opportunities. Personal time commitment. Running a sole proprietorship business requires personal sacrifices and a huge time commitment, often dominating the owner's life with 12-hour workdays and 7-day work weeks. Unstable business life. The lifespan of a sole proprietorship can be uncertain. The owner may lose interest, experience ill health, retire, or die. The business will cease to exist unless the owner makes provisions for it to continue operating or puts it up for sale. Losses are the owner's responsibility. The sole proprietor is responsible for all losses, although tax laws allow these to be deducted from other personal income. The sole proprietorship may be a suitable choice for a one-person startup operation with no employees and little risk of liability exposure. For many sole proprietors, however, this is a temporary choice, and as the business grows, the owner may be unable to operate with limited financial and managerial resources. At this point, the owner may decide to take in one or more partners to ensure that the business continues to flourish.
Catching the entrepreneurial spirit. Work-life balance important in small business. Survey data suggests that about half of small business owners are satisfied with how they balance their personal lives and work schedules, with some reporting working twice as much as regular employees. Surveys indicate that over half of small business owners work more than 50 hours per week, with nearly 40% working over 60 hours per week. Many business owners face stress and mental exhaustion, with financial concerns being top of list on stress points. However, being a small business owner puts a person in charge of their destiny, offers freedom, and can be very rewarding. Despite the stress and work hours, many are satisfied with being small business owners in general. Dennis Jacoby, chief economist at Gallup, argues, "People see the benefits more closely tied to them when they're the owner," he says. Working hard and long is a natural aspect of the kind of people willing to start their own business. But if employees have trouble balancing work and life, odds are they will have less confidence in you as a leader. When leaders model work-life balance and implement flexible work options, they create a culture of trust and support. Supported employees are generally more productive and less likely to leave. The Society for Human Resource Management's SHRM research also shows work-life balance has a great impact on how employees feel about their leaders. Jennifer Schramm, former manager in SHRM's Workplace/Workforce Trends and Forecasting program, and now a senior strategic policy advisor at AARP, predicts that as companies try to maximize the productivity of each employee, work-life balance and the resulting employee satisfaction will become increasingly more important. And research shows that happy employees can yield happy returns for businesses. Critical thinking questions. 1. Many small business owners expect their employees to be as committed and to work as hard as they do. How would you avoid falling into that trap while still demanding the best from your workers? 2. As a small business owner, consider some strategies to ensure an appropriate work-life balance for your employees.
Concept check. 1. What is a sole proprietorship? 2. Why is this a popular form of business organization? 3. What are the drawbacks to being a sole proprietor?
4.2 Partnerships. Sharing the load. Learning outcome. What are the advantages of operating as a partnership, and what downside risks should partners consider?
Can partnerships, an association of two or more individuals who agree to operate a business together for profit, be hazardous to a business's health? Let's assume partners Reggie and Liz own a stylish and successful beauty salon. After a few years of operating the business, they find they have contrasting visions for their company. Liz is happy with the status quo, while Reggie wants to expand the business by bringing in investors and opening salons in other locations. How do they resolve this impasse? By asking themselves some tough questions. Whose view of the future is more realistic? Does the business actually have the expansion potential Reggie believes it does? Where will he find investors to make his dream of multiple locations a reality? Is he willing to dissolve the partnership and start over again on his own? And who would have the right to their clients? Reggie realizes that expanding the business in line with his vision would require a large financial risk, and that his partnership with Liz offers many advantages he would miss in a sole proprietorship form of business organization. After much consideration, he decides to leave things as they are. For those individuals who do not like to go it alone, a partnership is relatively simple to set up. Offering a shared form of business ownership, it is a popular choice for professional service firms such as lawyers, accountants, architects, stockbrokers, and real estate companies. The parties agree, either orally or in writing, to share in the profits and losses of a joint enterprise. A written partnership agreement, spelling out the terms and conditions of the partnership, is recommended to prevent later conflicts between the partners. Such agreements typically include the name of the partnership, its purpose, and the contributions of each partner, such as financial, asset, skills, or talent. It also outlines the responsibilities and duties of each partner and their compensation structure, including salary, profit sharing, and so on. It should contain provisions for the addition of new partners, the sale of partnership interests, and procedures for resolving conflicts, dissolving the business, and distributing the assets. There are two basic types of partnerships: general and limited. In a general partnership, all partners share in the management and profits. They co-own the assets, and each can act on behalf of the firm. Each partner also has unlimited liability for all the business obligations of the firm. A limited partnership has two types of partners: one or more general partners who have unlimited liability, and one or more limited partners whose liability is limited to the amount of their investment. In return for limited liability, limited partners agree not to take part in the day-to-day management of the firm. They help to finance the business, but the general partners maintain operational control. There are also limited liability partnerships, LLP, which are similar to a general partnership, except that partners are not held responsible for the business debt and liabilities. Another type is a limited liability limited partnership, LLLP, which is basically a limited partnership with addition of limited liability, hence protecting the general partner from the debt and liabilities of the partnership. Advantages of partnerships. Some advantages of partnerships come quickly to mind. Ease of formation. Like sole proprietorships, partnerships are easy to form. The partners agree to do business together and draw up a partnership agreement. For most partnerships, applicable state laws are not complex. Availability of capital. Because two or more people contribute financial resources, partnerships can raise funds more easily for operating expenses and business expansion. The partners' combined financial strength also increases the firm's ability to raise funds from outside sources. Diversity of skills and expertise. Partners share the responsibilities of managing and operating the business. Combining partner skills to set goals, manage the overall direction of the firm, and solve problems increases the chances for the partnership's success. To find the right partner, you must examine your own strengths and weaknesses and know what you need from a partner. Ideal partnerships bring together people with complementary backgrounds rather than those with similar experience, skills, and talents. In Table 4.1, you'll hear some advice on choosing a partner. Flexibility. General partners are actively involved in managing their firm and can respond quickly to changes in the business environment. No special taxes. Partnerships pay no income taxes. A partnership must file a partnership return with the Internal Revenue Service, reporting how profits or losses were divided among the partners. Each partner's profit or loss is then reported on the partner's personal income tax return, with any profits taxed at personal income tax rates. Relative freedom from government control. Except for state rules for licensing and permits, the government has little control over partnership activities.
Table 4.5. Perfect partners. Picking a partner is both an art and a science. Someone may have all the right credentials on paper, but does that person share your vision and the ideas you have for your company? Are they a straight shooter? Honesty, integrity, and ethics are important because you may be liable for what your partner does. Be prepared to talk about everything. And trust your intuition and your gut feelings. They're probably right. Ask yourself and your potential partner the following questions. Then see how well your answers match up. 1. Why do you want a partner? 2. What characteristics, talents, and skills does each person bring to the partnership? 3. How will you divide responsibilities from long-range planning to daily operations? Who will handle such tasks as marketing, sales, accounting, and customer service? 4. What is your long-term vision for the business? Its size, lifespan, financial commitment, and so on. 5. What are your personal reasons for forming this company? Are you looking to create a small company or build a large one? Are you seeking a steady paycheck or financial independence? 6. Will all parties put in the same amount of time, or is there an alternative arrangement that is acceptable to everyone? 7. Do you have similar work ethics and values? 8. What requirements will be in the partnership agreement?
Disadvantages of partnerships. Business owners must consider the following disadvantages of setting up their company as a partnership. Unlimited liability. All general partners have unlimited liability for the debts of the business. In fact, any one partner can be held personally liable for all partnership debts and legal judgments, such as malpractice, regardless of who caused them. As with sole proprietorships, business failure can lead to a loss of the general partner's personal assets. To overcome this problem, many states now allow the formation of limited liability partnerships, LLPs, which protect each individual partner from responsibility for the acts of other partners and limit their liability to harm resulting from their own actions. Potential for conflicts between partners. Partners may have different ideas about how to run their business, which employees to hire, how to allocate responsibilities, and when to expand. Differences in personalities and work styles can cause clashes or breakdowns in communication, sometimes requiring outside intervention to save the business. Complexity of profit sharing. Dividing the profits is relatively easy if all partners contribute equal amounts of time, expertise, and capital. But if one partner puts in more money and others more time, it might be more difficult to arrive at a fair profit-sharing formula. Difficulty exiting or dissolving a partnership. As a rule, partnerships are easier to form than to leave. When one partner wants to leave, the value of their share must be calculated. To whom will that share be sold? And will that person be acceptable to the other partners? If a partner who owns more than 50% of the entity withdraws, dies, or becomes disabled, the partnership must reorganize or end. To avoid these problems, most partnership agreements include specific guidelines for transferring partnership interests and buy-sell agreements that make provision for surviving partners to buy a deceased partner's interest. Partners can also purchase special life insurance policies designed to fund such a purchase. Business partnerships are often compared to marriages. As with a marriage, choosing the right partner is critical. So if you are considering forming a partnership, allow plenty of time to evaluate your and your potential partner's goals, personality, expertise, and working style before joining forces.
Concept check. 1. How does a partnership differ from a sole proprietorship? 2. Describe the four main types of partnerships And explain the difference between a limited partner and a general partner. 3. What are the main advantages and disadvantages of a partnership?
4.3. Corporations. Limiting your liability. Learning objective. How does the corporate structure provide advantages and disadvantages to a company? And what are the major types of corporations?
When people think of corporations, they typically think of major, well-known companies such as Meta, Costco, JP Morgan Chase, and Verizon. But corporations range in size from large multinationals with thousands of employees and billions of dollars in sales, to mid-size or even smaller firms with few employees and revenues well under the millions of dollars. That large. Corporations garner. A corporation is a legal entity subject to the laws of the state in which it is formed, where the right to operate as a business is issued by state charter. A corporation can own property, enter into contracts, sue and be sued, and engage in business operations under the terms of its charter. Unlike sole proprietorships and partnerships, corporations are taxable entities with a life separate from their owners, who are not personally liable for its debts. At launch, the founder of Executive Property Management Services chose to incorporate to obtain the liability protection of the corporate form of business organization. The company specialized in providing customized property management services to corporate executives with long-term work assignments abroad. Taking care of substantial properties in the million-dollar range and above was no small responsibility. Therefore, the protection of a corporate business structure, along with carefully detailed contracts outlining the company's obligations, were crucial in providing the liability protection needed, and the peace of mind to focus on running the business without constant worry. Note that an LLC does not provide unlimited protection. You can still get in trouble for such things as mingling personal and business funds. Corporations play an important role in the U.S. economy. As previously discussed, corporations account for a small portion of all businesses, but generate the vast majority of all revenues and profits. Company type and size vary. However, when you look at the top companies by revenue in the United States or globally, they include many familiar names that affect our daily lives. In the United States, according to Fortune magazine, the top 3 corporations in 2025 were 1. Walmart, with $681 billion in revenue. 2. Amazon, with $638 billion in revenue. And 3. United Health Group, with $400 billion in revenue. According to the Forbes Global 2000 list for 2025, which ranks companies using a composite score of sales, profits, assets, and market value, the top 3 U.S. corporations are JP Morgan Chase, with $285 billion in revenue. Berkshire Hathaway, with $371 billion in revenue. And Amazon, with $638 billion in revenue. Note that while Amazon ranks 3rd on the Global 2000 list, it actually has the highest revenue of the top 3 because the Forbes ranking uses a composite methodology that factors in not just revenue sales, but also profits, assets, and market capitalization. By comparison, the top 3 companies, according to December 2025 market capitalization rankings, are 1. NVIDIA, with a market cap of roughly $5 trillion. 2. Apple, with a market cap of roughly $4 trillion. And 3. Microsoft, with a market cap of approximately $3.9 trillion. These corporations rise and fall on the various lists based on the differing metrics used in the ranking processes, which often include measures beyond simply ranking by revenues. Although the lists do not always align, it is clear that corporations have a significant impact on the economy.
Managing change. PacSun's Golden Glow. It all started as a little surf shop in 1980 in Newport Beach, California. It wasn't called PacSun then. It wasn't even all that different from other shops carrying surfboards and wax, except for one thing. The founders had a better idea. During Southern California's wet, cool winters, the beaches got empty and the surf store business went dry. Where did everyone go? to the mall, of course. Their idea, to be the first surf shop to move into California's popular mall locations, worked. The company soon grew to 21 stores, selling such popular name brands as Billabong, Gotcha, Stussy, and Quicksilver, as well as its own private label brands. What began as a little surf shop became a leading mall-based specialty retailer in the fast-growing surf, skate, and hip-hop apparel markets. With close to 1,000 stores in the United States and Puerto Rico, and sales topping $1 billion, how did the founders make the leap from selling and waxing surfboards to being a major player in the youth apparel market? How has Pacific Sunwear of California, Incorporated, succeeded when thousands of other clothing companies failed? We listen and we change, says the CEO of Pacific Sun. The kids have the answers, so we listen to get the trends, the solutions, and find out what we are doing right. To remain on the cutting edge of teen tastes, the company regularly hosted an open house at its corporate headquarters in Anaheim, California, where vendors presented their wares to PacSun's savvy team of buyers. In 2025, PacSun organized the Purpose Partner Summit, which gathered leaders from various industries to discuss aspects of youth culture. Being able to distinguish between short-lived fads and actual trends is important when making merchandise choices. The company's focus on active brand management is what kept its sales climbing. The founders' philosophy had served their business well. In 1993, the 60-store company sold stock to the public. It had grown to over 1,000 stores in 50 states, and Puerto Rico, with 12,000 employees. The company's PacSun stores cater to a completely different customer than its DEMO. Hip-hop stores. In April 2006, PacSun launched its third concept, 1,000 Steps, a footwear store. With changing trends and online shopping challenges facing many brick-and-mortar retailers, companies such as Wet Seal and Quicksilver filed for bankruptcy in 2015, and PacSun filed for bankruptcy in April 2016. At the time of bankruptcy filing, the company had 593 PacSun stores, employing approximately 2,000 employees. In September 2016, PacSun emerged from the bankruptcy after it cut debt and closed stores. The company also turned over all of its stock to the private equity firm Golden Gate Capital, its senior lender. As its business took off, PacSun successfully made the leap from the small sole proprietorship form of business organization to corporate retailing giant. Facing changing trends and technologies, the firm hit a bump in the road, worked hard to reestablish, and has continued to remain at the forefront of youth culture and trends. The company is indeed 1,000 steps away from its humble beginnings. Critical thinking questions. 1. How did PacSun manage its evolution from a small local business to a leading mall-based specialty retailer? What could be the reasons for its missteps resulting in the bankruptcy filing? 2. What form of business organization might PacSun have chosen when it started, and what might have prompted it to change as it grew?
The incorporation process. Setting up a corporation is more complex than starting a sole proprietorship or partnership. Most states base their laws for chartering corporations on the Model Business Corporation Act of the American Bar Association, although registration procedures, fees, taxes, and laws that regulate corporations vary from state to state. A firm does not have to incorporate in the state where it is based, and may benefit by comparing the rules of several states before choosing a state of incorporation. Although Delaware is a small state with few corporations actually based there, its pro-corporate policies make it the state of incorporation for many companies, including about half the Fortune 500. Incorporating a company involves the following phases. Select the company's name. Choose a company location. Decide on a corporate classification. Write the articles of incorporation and file them with the appropriate state office, usually the Secretary of State. Obtain an EIN, Employer Identification Number, from the IRS. Establish a business bank account. File the required state licenses and permits, and pay fees and taxes. The state issues a corporate charter based on information in the Articles of Incorporation. Once the corporation has its charter, it holds an organizational meeting to adopt bylaws, elect directors, and pass initial operating resolutions. Bylaws provide legal and managerial guidelines for operating the firm.
Table 4.2. Articles of Incorporation. Articles of incorporation are prepared on a form authorized or supplied by the state of incorporation. Although they may vary slightly from state to state, all articles of incorporation should include the following elements: name and address of the corporation, type of corporation, names and addresses of the initial members of the board of directors, types of stock and number of shares to issue, life of the corporation, usually perpetual, meaning with no time limit.
The corporate structure. Corporations have their own organizational structure with three important components: stockholders, directors, and officers. Stockholders, or shareholders, are the owners of a corporation, holding shares of stock that provide them with certain rights. They may receive a portion of the corporation's profits in the form of dividends, and they can sell or transfer their ownership in the corporation, represented by their shares of stock, at any time. Stockholders can attend annual meetings, elect the board of directors, and vote on matters that affect the corporation in accordance with its charter and bylaws. Each share of stock generally carries one vote. The stockholders elect a board of directors to govern and handle the overall management of the corporation. The directors set major corporate goals and policies, hire corporate officers, and oversee the firm's operations and finances. Laws vary by state, but small firms may have as few as 3 directors, whereas large corporations usually have 9 to 12. The boards of large corporations typically include both corporate executives and outside directors, not employed by the organization, chosen for their professional and personal expertise. Outside directors often bring a fresh view to the corporation's activities because they are independent of the firm. Hired by the board, the officers of a corporation are its top management, and the CEO, Chief Executive Officer, the Chief Financial Officer, CFO, and the Lead Operations Officer, who are responsible for achieving corporate goals and policies. Officers may also be board members and stockholders. Advantages of corporations. The corporate structure allows companies to merge financial and human resources into enterprises with great potential for growth and profits. Limited liability. A key advantage of corporations is that they are separate legal entities that exist apart from their owners. Owners, stockholders, liability for the obligations of the firm is limited to the amount of the stock they own. If the corporation goes bankrupt, creditors can look only to the assets of the corporation for payment. Ease of transferring ownership. Stockholders of public corporations can sell their shares at any time without affecting the status of the corporation. Unlimited life. The life of a corporation is unlimited. Although corporate charters specify a life term, they also include rules for renewal. Because the corporation is an entity separate from its owners, the death or withdrawal of an owner does not affect its existence, unlike a sole proprietorship or partnership. Tax deductions. Corporations are allowed certain tax deductions, such as operating expenses, which reduces their taxable income. Ability to attract financing. Corporations can raise money by selling new shares of stock. Dividing ownership into smaller units makes it affordable to more investors, who can purchase shares of stock which represent portions of ownership in the company. The large size and stability of corporations also helps them get bank financing. All these financial resources allow corporations to invest in facilities and human resources and expand beyond the scope of sole proprietorships or partnerships. Sole proprietorships and partnerships do not have access to the same level of financing as corporations. As such, it can be challenging for these entities to obtain the capital necessary for large-scale operations. Disadvantages of corporations. Although corporations offer companies many benefits, they have some disadvantages. Double taxation of profits. Corporations must pay federal and state income taxes on their profits. In addition, any profits, dividends, paid to stockholders are taxed as personal income, although at a somewhat reduced rate. Cost and complexity of formation. As outlined earlier, forming a corporation involves several steps, and costs can vary based on the location and complexity of the corporation, but could be several $1,000s, including state filing, registration, and license fees, as well as the cost of attorneys and accountants. More government restrictions. Unlike sole proprietorships and partnerships, corporations are subject to many regulations and reporting requirements. For example, corporations must register in each state where they do business and must also register with the Securities and Exchange Commission, SEC, before selling stock to the public. Unless it is closely held, owned by a small group of stockholders, a firm must publish financial reports on a regular basis and file other special reports with the SEC and state and federal agencies. These reporting requirements can impose substantial costs, and published information on corporate operations may also give competitors an advantage. Types of corporations. 3 types of corporate business organization provide limited liability. The C corporation is the conventional or basic form of corporate organization. Small businesses may achieve liability protection through S corporations or limited liability companies, LLCs. An S corporation is a hybrid entity, allowing smaller corporations to avoid double taxation of corporate profits, as long as they meet certain size and ownership requirements. Organized like a corporation with stockholders, directors, and officers, an S corporation is taxed like a partnership. Income and losses flow through to the stockholders and are taxed as personal income. S corporations are allowed a maximum of 100 qualifying shareholders and 1 class of stock. The owners of an S corporation are not personally liable for the debts of the corporation. A newer type of business entity, the limited liability company, LLC, is also a hybrid organization. Like S corporations, they appeal to small businesses because they are easy to set up and not subject to many restrictions. LLCs offer the same liability protection as corporations, as well as the option of being taxed as a partnership or a corporation. LLCs are most often taxed as pass-through entities wherein the LLC itself does not pay taxes. Instead, the income is passed to the members of the LLC, who then report the income on their individual tax returns, much like a sole proprietorship. First authorized in Wyoming in 1977. LLCs became popular after a 1988 tax ruling that treats them like partnerships for tax purposes. Today, all states allow the formation of LLCs. Table 4.3 summarizes the advantages and disadvantages of each form of business ownership.
Table 4.3. Advantages and disadvantages of major types of business organization. In the following section, we will discuss the pros and cons of sole proprietorships, partnerships, and corporations.
Sole proprietorships. Advantages. Owner receives all profits. Low organizational costs. Income taxed as personal income of proprietor. Independence. Maintain control of trade secrets and intellectual property. Ease of dissolution. Disadvantages. Owner receives all losses. Owner has unlimited liability. Total wealth can be taken to satisfy business debts. Limited fundraising ability can inhibit growth. Proprietor may have limited skills and management expertise. Few long-range opportunities and benefits for employees. Lacks continuity when owner dies.
Partnerships. Advantages. More expertise and managerial skills available. Relatively low organizational costs. Income taxed as personal income of partners. Fundraising ability is enhanced by more owners. Disadvantages. Owners have unlimited liability, may have to cover debts of other, less financially sound partners. Dissolves or must reorganize when partner dies. Difficult to liquidate or terminate. Potential for conflicts between partners. Difficult to achieve large-scale operations.
Corporations. Advantages. Limited liability protects owners from losing more than they invest. Can achieve large size due to marketability of stock ownership. Receives certain tax advantages. Greater access to financial resources. Allows growth. Can attract employees with specialized skills. Ownership is readily transferable. Long life of firm, which is not affected by the death of owners. Disadvantages: more expensive and complex to form. Subject to more government regulation. Financial reporting requirements make operations public. Double taxation, because both corporate profits and dividends paid to owners are taxed, although the dividends are taxed at a reduced rate.
Concept check. 1. What is a corporation? Describe how corporations are formed and structured. 2. Summarize the advantages and disadvantages of corporations. Which features contribute to the dominance of corporations in the business world? 3. Why do S corporations and limited liability companies, LLCs, appeal to small businesses?
4.4 Specialized Forms of Business Organization. Learning objective. What other options for business organization does a company have in addition to sole proprietorships, partnerships, and corporations?
In addition to the three main forms, several specialized types of business organization also play an important role in our economy. We will look at cooperatives and joint ventures in this section and take a detailed look at franchising in the following section. Cooperatives. When you eat a sun-kissed orange or spread Land O'Lakes butter on your toast, you are consuming foods produced by cooperatives. A cooperative is a legal entity with several corporate features, such as limited liability, an unlimited lifespan, an elected board of directors, and an administrative staff. Member owners pay annual fees to the cooperative and share in the profits, which are distributed to members in proportion to their contributions. Because they do not retain any profits, cooperatives are not subject to taxes. There are currently 3 million cooperatives, with 1 billion members employing nearly 300 million employees in more than 145 countries worldwide. Cooperatives operate in every industry, including agriculture, education, financial services, food retail, healthcare, insurance, and utilities. They range in size from large enterprises such as Fortune 500 companies to small local storefronts and fall into the following categories: consumer and purchasing, financial, producer and processing, housing, and worker. Cooperatives are autonomous businesses owned and democratically controlled by their members, the people who buy their goods or use their services, not by investors. Unlike investor-owned businesses, cooperatives are organized solely to meet the needs of the member owners, not to accumulate capital for investors. As democratically controlled businesses, many cooperatives practice the principle of one member, one vote, providing members with equal control over the cooperative. There are two types of cooperatives. Buyer cooperatives combine members' purchasing power. Pooling buying power and buying in volume increases purchasing power and efficiency, resulting in lower prices. At the end of the year, members get shares of the profits based on how much they bought. Obtaining discounts to lower costs gives the corner Ace Hardware store the chance to survive against retailing giants such as Menards and Home Depot. Founded in 1924, Ace Hardware is one of the nation's largest cooperatives and is wholly owned by its independent hardware retailer members in stores spanning all 50 states and 70 countries. In August 2017, Ace opened its 5,000th store. In the second quarter of 2025, the company reported revenues of $2.8 billion, which was an increase of 3.9% from the second quarter of 2024. The net income for the second quarter of 2025 was $119.1 million, an increase of $4.7 million, 4.1%, from the second quarter of 2024. Ace Hardware's revenue has nearly doubled since the second quarter of 2017, showing significant growth during the time period. Seller cooperatives are popular in agriculture, wherein individual producers join to compete more effectively with large producers. Member dues support market development, national advertising, and other business activities. In addition to Sunkist and Land O'Lakes, other familiar cooperatives are Calavo, avocados, Ocean Spray, cranberries and juices, and Blue Diamond nuts. CHS Incorporated the largest cooperative in the United States, sells energy, supply, food, and grain. Cooperatives empower people to improve their quality of life and enhance their economic opportunities through self-help. Throughout the world, cooperatives are providing members with credit and financial services, energy, consumer goods, affordable housing, telecommunications, and other services that would not otherwise be available to them. There are several principles that cooperatives should follow, according to the National Cooperative Business Association (CISUSA) International. They include 1. Voluntary and open membership, which means that cooperatives are open to all people to use their services. 2. Democratic member control, which means that organizations are controlled by their members. 3. Members' economic participation, which means that members contribute equally to the capital of the cooperative. 4. Autonomy and independence, which means cooperatives are self-help organizations controlled by their members. 5. Education, training, and information, which means that cooperatives provide education and training for their members while also electing representatives, managers, and employees. 6. Cooperation among cooperatives, which means that individual cooperatives work together for the betterment of all members. And 7. Concern for community, which means the cooperative's work takes into consideration both local and global community concerns. Joint ventures. In a joint venture, 2 or more companies form an alliance to pursue a specific project, usually for a specified time period. There are many reasons for joint ventures. The project may be too large for one company to handle on its own, and joint ventures also afford companies access to new markets, products, or technology. Both large and small companies can benefit from joint ventures. In 2025, Hyundai and General Motors, GM, announced a strategic alliance to jointly develop 5 vehicles, with production to begin in 2028. The venture allows sharing both the costs and benefits of new technological development in the sector. The companies will sell the vehicles with their individual brand names and will have some brand-specific design elements. Hyundai is gaining access to GM's expertise in the truck market, whereas GM is benefiting from Hyundai's expertise in hybrid and EV technologies.
Concept check. 1. Describe the 2 types of cooperatives and the advantages of each. 2. What are the benefits of joint ventures?
.5 Franchising, a popular trend. Learning objective. What makes franchising an appropriate form of organization for some types of business? And why does it continue to grow in importance?
When Amare Strayer decided to buy a franchise, he researched the usual suspects: Jiffy Lube, McDonald's, and Quiznos subs. Strayer, then 38, was a top executive at a dying technology firm. Instead of becoming another McDonald's franchisee, Strayer chose to remain in the technology sector by purchasing a Geeks on Call franchise. Geeks on Call is a company that provides on-site computer assistance via a large pool of experienced techies. Strayer makes residential and commercial house calls as a Geeks on Call franchisee. Choosing the right franchise can be challenging. Franchises come in all sizes and demand different skills and qualifications. And with somewhere around 3,000 different franchise businesses in the United States, Boston had a lot to choose from cookie bouquet peddlers and dog trainers to acupuncture specialists. Table 4.4 shows the top franchises for 2017 from various sources. Entrepreneurs' rankings utilize, among other factors, costs, fees, brand strength, support, and financial strength. Franchise Business Review focuses on owner satisfaction, whereas Franchise Gator utilizes a formula with factors such as financial stability and engagement.
The following is a high-level summary for Table 4.4, which displays the top franchises for 2026. A look at the top U.S. franchises for 2026 reveals a diverse market, as tracked by 3 major industry authorities. Entrepreneur's Franchise 500 list is heavily dominated by major food and beverage chains like Taco Bell, Jersey Mike's, and Popeyes. Meanwhile, Franchise Business Review's Most Innovative list highlights specialized, lower-cost models like Kona Ice and Next Home. Finally, Franchise Gator's Top 100 points to a boom in mobile and niche services, crowning brands like Zoomin Groomin Pet Care and Postal Annex Plus as top contenders for the year.
Chances are, you recognize some of the names listed in Table 4.4 and deal with franchise systems in your neighborhood every day. When you have lunch at Taco Bell or Jamba Juice, change your oil at Jiffy Lube, buy candles at Wicks and Sticks, or mail a package at the UPS store, you are dealing with a franchised business. These and other familiar name brands mean quality, consistency, and value to consumers. Franchise businesses provided about 8.9 million direct jobs with an $890 billion economic output for the U.S. economy. Franchising is a form of business organization that involves a franchisor, the company supplying the product or service concept, and the franchisee, the individual or company selling the goods or services in a certain geographic area. The franchisee buys a package that includes a proven product or service, proven operating methods, and training in managing the business, offering a way to own a business without starting it from scratch, and to expand operations quickly into new geographic areas with limited capital investment. Franchising is one of the fastest growing segments of the economy. If you are interested in franchising, food companies represent the largest number of franchises. A franchise agreement is a contract that allows the franchisee to use the franchisor's business name, trademark, and logo. The agreement also outlines rules for running the franchise, services provided by the franchisor, and financial terms. The franchisee agrees to follow the franchisor's operating rules by keeping inventory at certain levels, buying a standard equipment package, keeping up sales and service levels, taking part in franchisor promotions, and maintaining a relationship with the franchisor. In return, the franchisor provides the use of a proven company name and symbols, help in finding a site, building plans, guidance and training, management assistance, managerial and accounting systems and procedures, employee training, wholesale prices for supplies, and financial assistance. Advantages of franchises. Like other forms of business organization, franchising offers some distinct advantages. Increased ability for franchisor to expand. Because franchisees finance their own units, franchisors can grow without making a major investment. Recognized name, product, and operating concept. Consumers know they can depend on products and services from franchises such as Chick-fil-A, Visiting Angels, and Sports Clips. As a result, the franchisee's risk is reduced and the opportunity for success increased. The franchisee gets a widely known and accepted business with a proven track record, as well as operating procedures, standard goods and services, and national advertising. Management training and assistance. The franchisor provides a structured training program that gives the new franchisee a crash course in how to start and operate their business. Ongoing training programs for managers and employees are another plus. In addition, franchisees have a peer group for support and sharing ideas. Financial assistance. Being linked to a nationally known company can help a franchisee obtain funds from a lender. Also, the franchisee advice on financial management, referrals to lenders, and help in preparing loan applications. Many franchisors also offer short-term credit for buying supplies, payment plans, and loans to purchase real estate and equipment. Although franchisors give up a share of profits to their franchisees, they receive ongoing revenues in the form of royalty payments. Disadvantages of franchises. Franchising also has some disadvantages. Loss of control. The franchisor has to give up some control over operations and has less control over its franchisees than over company employees. Cost of franchising. Franchising can be a costly form of business. Costs will vary depending on the type of business and may include expensive facilities and equipment. The franchisee also pays fees and/or royalties, which are usually tied to a percentage of sales. Fees for national and local advertising and management advice may add to a franchisee's ongoing costs. Restricted operating freedom. The franchisee agrees to conform to the franchisor's operating rules and facilities design, as well as inventory and supply standards. Some franchisees require franchisees to purchase from only the franchisor or approved suppliers. The franchisor may also restrict the franchisee's territory or site, which could limit growth. Failure to conform to franchisor policies could mean the loss of the franchise. Franchise growth. Many of today's major franchise brands, such as McDonald's and KFC, started in the 1950s. Through the 1960s and 1970s, many more types of businesses, including personal and business services, used franchising to distribute their goods and services. Growth comes from expansion of established franchises. For example, Subway, Pizza Hut, and Orange Theory Fitness, as well as new entrants, such as those identified by Entrepreneur and Franchise Gator, among other sources. According to Entrepreneur magazine, the top 3 new franchises in 2025 are 1. Koala Insulation, 2. Travel and Tom's Coffee, and 3. QC Kinetics, whereas, according to Franchise Gator, the top 3 emerging franchises for 2026 are 1. Zoom and Grumman, Pet Industry, 2. Postal Annex Plus Business Services, and 3. Mr. Electric, Home Services and Repair. Ranking lists are generated based on different factors such as ease of opening, startup costs, and potential for growth. Changing demographics drive franchise industry growth in terms of who, how, and what experiences the most rapid growth. The continuing growth and popularity of technology and personal computing is responsible for the rapidly multiplying number of eBay drop-off stores, and tech consultants such as Geeks on Call are in greater demand than ever. Other growth franchise industries are personal services such as fitness franchises, retail food, and senior care. The next big thing in franchising. All around you, people are talking about the next big thing. Closets by Design is the solution for a perfectly organized home. The workout at Planet Fitness is the answer to America's fitness needs, and you are ready to take the plunge and buy a trendy franchise. But consumers' desires can change with the tide. So, how do you plan an entrance and exit strategy when purchasing a franchise that's a big hit today but could be old news by tomorrow? Table 4.5 outlines some tips on purchasing a franchise. International franchising. Like other forms of business, franchising is part of our global marketplace economy. As international demand for all types of goods and services grows, most franchise systems are already operating internationally or planning to expand overseas. Quick service restaurants, lodging, business services, and personal services are popular international franchises. Franchisors in foreign countries face many of the same problems as other firms doing business abroad. In addition to tracking markets and currency changes, franchisors must understand local culture, language differences, and the political environment. Franchisors in foreign countries also face the challenge of aligning their business operations with the goals of their franchisees, who may be located across the world.
Table 4.5. Tips for purchasing a franchise. 1. Reflect on your reasoning for the venture and assess the skills needed to be successful. 2. Do your research and consult with tax advisors and attorneys before signing. 3. Complete the application process. 4. Determine your business structure and location. 5. Apply for financing as needed. 6. Utilize training and support offered by franchisor.
Is franchising in your future? Are you ready to be a franchisee? Before taking the plunge, ask yourself some searching questions. Are you excited about a specific franchise concept? Are you willing to work hard and put in long hours? Do you have the necessary financial resources? Do you have prior business experience? Do your expectations and personal goals match the franchisors? Qualities that rank high on franchisors' lists are passion about the franchise concept, desire to be your own boss, willingness to make a substantial time commitment, assertiveness, optimism, patience, and integrity. Prior business experience is also a definite plus, and some franchisors prefer or require experience in their field. So, what can you do to prepare when considering the purchase of a franchise? When evaluating franchise opportunities, professional guidance can prevent expensive mistakes. So, interview advisors to find those that are right for you. Selecting an attorney with franchise experience will hasten the review of your franchise agreement. Getting to know your banker will speed up the loan process if you plan to finance your purchase with a bank loan. So stop by and introduce yourself. The proper real estate is a critical component for a successful retail franchise. So establish a relationship with a commercial real estate broker to begin scouting locations. Doing your homework can spell the difference between success and failure, and some early preparation can help lay the groundwork for the successful launch of your franchise business. If the franchise route to business ownership seems right for you, begin educating yourself on the franchise process by investigating various franchise opportunities. You should research a franchise company thoroughly before making any financial commitment. Once you've narrowed your choices, ask for the Franchise Disclosure Document, FDD, for that franchisor, and read it thoroughly. The Federal Trade Commission, FTC, requires franchisors to prepare this document, which provides a wealth of information about the franchisor, including its history, operating style, management past or pending litigation, the franchisee's financial obligations, and any restrictions on the sale of units. Interviewing current and past franchisees is another essential step. Would-be franchisees should also check recent issues of small business magazines such as Entrepreneur Incorporated, Startups, and Success for Industry Trends, ideas on promising franchise opportunities, and advice on how to choose and run a franchise. The International Franchise Association website at www.franchise.org has links to Franchising World and other useful sites. For other franchise-related sites, see the Working the Net questions for this chapter.
Expanding around the globe. Setting up sandwich shop in China. Lured by China's fast food industry, estimated today at $180 billion, Jim Bryant, former China Subway franchise owner, now retired, 50, was not the only entrepreneur to discover it is hard to do business in China. Over 10 years, Bryant opened 19 Subway stores in Beijing, only half the number he was supposed to have by then, while other companies, such as Chili's and Dunkin', have made the decision to leave the Chinese market. Subway, or Saibei Wei, Mandarin for tastes better than others, is now in the top 5 largest U.S. fast food chains in China, along with McDonald's, KFC, and Starbucks. Although Bryant had never eaten a Subway sandwich before, Jana Brands, the company Bryant worked for in China, sold $20 million in crab to Subway annually, so he knew it was big business. When Subway founder Fred DeLuca visited Beijing in 1994, Bryant took him to a place not on the official tour, McDonald's. It was Sunday night, and the place was packed. "We could open 20,000 Subways here and not scratch the surface," Bryant remembers DeLuca saying. 2 weeks later, Bryant called Subway's headquarters in Milford, Connecticut, and asked to be the company representative in China. He would recruit local entrepreneurs, train them to become franchisees, and act as a liaison between them and the company. He would receive half the initial $10,000 franchise fee and 1/3 of their 8% royalty fees. He could also open his own Subway restaurants. Steve Foreman, the founder of Jana Brands, invested $1 million in return for a 75% stake. All foreign businesses in China had to be joint ventures with local partners. So Bryant used the Chinese business practice of relying on local relationships to find a manager for his first restaurant in Beijing. The project ran into problems immediately. Work on the store was delayed and construction costs soared. It didn't take Bryant long to realize that he and Foreman had been swindled out of $200,000. When it finally opened, the restaurant was a hit among Americans in Beijing, but the locals weren't sure what to make of it. They didn't know how to order and didn't like the idea of touching their food, so they held the sandwich vertically, peeled off the paper, and ate it like a banana. Most of all, the Chinese didn't seem to want sandwiches. But Subway did little to alter its menu, something that still irks some Chinese franchisees. Tailoring menu items to local tastes could show potential customers respect for local culture. Bryant, however, insisted that with time, sandwiches would catch on in China. Maybe he's right. Tuna salad, which he couldn't give away at first, is now the #1 seller. Today, there are around 670 Subway stores in China, with China's fast food industry estimated at over $180 billion. Critical thinking questions. 1. What are some of the main problems U.S. franchisors encounter when attempting to expand their business in a country such as China? 2. What steps can franchisors take to ensure a smooth and successful launch of a new franchise business in a foreign country?
Concept check. 1. Describe franchising and the main parties to the transaction. 2. Summarize the major advantages and disadvantages of franchising. 3. Why has franchising proved so popular?
Four point six. Mergers and acquisitions. Learning objective. Why are mergers and acquisitions important to a company's overall growth?
A merger occurs when two or more firms combine to form one new company. For example, in 2016, Johnson Controls, a leading provider of building efficiency solutions, agreed to merge with Ireland's Tyco International, a leading provider of fire and security solutions, resulting in a company that will be a leader in products, technologies, and integrated solutions for the building and energy sectors. At the time, the merger was valued at $30 billion, with new Johnson Controls plc to be based in Ireland. As another example, AT&T and Time Warner merged, representing a significant change in the telecommunications landscape. The newly merged company brought together both content and delivery under one umbrella. Mergers such as this one, in a well-established industry, can produce winning results in terms of improved efficiency and cost savings. In an acquisition, a corporation or investor group finds a target company and negotiates with its board of directors to purchase it. In 2025, T-Mobile acquired US Cellular for over $4 billion. This strategic move by T-Mobile allows the existing US Cellular customers the ability to seamlessly move to T-Mobile. Additionally, for T-Mobile, the acquisition opens up new rural networks to align with their strategic goals. Worldwide merger activity was up significantly in 2025 after several years of decline, in part due to stabilizing interest rates and favorable economic conditions. There was a good deal of activity in the tech sector specifically. We will discuss the increase in international mergers later in this chapter. Types of mergers. The three main types of mergers are horizontal, vertical, and conglomerate. In a horizontal merger, companies at the same stage in the same industry merge to reduce costs, expand product offerings, or reduce competition. Many of the largest mergers are horizontal mergers to achieve economies of scale. Its $1.25 billion acquisition of trucking company Overnight allowed UPS, one of the world's largest shipping carriers, to step up expansion of its heavy freight delivery business, thus expanding its product offerings. In a vertical merger, a company buys a firm in its same industry, often involved in an earlier or later stage of the production or sales process. Buying a supplier of raw materials, a distribution company, or a customer gives the acquiring firm more control. AT&T's deal with Time Warner is a good example. The move enabled Time Warner to have a hand in the distribution of their content through AT&T's networks. A conglomerate merger brings together companies in unrelated businesses to reduce risk. Combining companies whose products have different seasonal patterns or respond differently to business cycles can result in more stable sales. The Philip Morris Company, now called Altria Group, started out in the tobacco industry, but diversified as early as the 1960s with the acquisition of Miller Brewing Company. It diversified into the food industry with its subsequent purchase of brands including General Foods, Kraft Foods, and Nabisco, among others, later spinning off many businesses. Current product categories include cigarettes, smokeless tobacco such as Copenhagen and Squall, cigars, e-vapor products such as Mark 10, and wines. A specialized, financially motivated type of merger, the leveraged buyout, LBO, became popular in the 1980s, but is less common today. LBOs are corporate takeovers financed by large amounts of borrowed money, as much as 90% of the purchase price. LBOs can be started by outside investors or the corporation's management. For example, in the healthcare sector, Athena Health was purchased by a private equity firm in 2021 for nearly $20 billion in a leveraged buyout. Often, a belief that a company is worth more than the value of all its stock is what drives an LBO. They buy the stock and take the company private, expecting to increase cash flow by improving operating efficiency or selling off units for cash to pay off debt. Although some LBOs do improve efficiency, many do not live up to investor expectations or generate enough cash to pay their debt. Merger motives. Although headlines tend to focus on mega mergers, merger mania affects small companies too, and motives for mergers and acquisitions tend to be similar regardless of the company's size. The goal is often strategic: to improve overall performance of the merged firms through cost savings, elimination of overlapping operations, improved purchasing power, increased market share, or reduced competition. For example, Oracle Corporation acquired Addy Insights in 2022 to expand its software portfolio to include workforce management features such as scheduling and overtime management. Company growth, broadening product lines, acquiring technology or management skills, and the ability to quickly acquire new markets are other motives for acquiring a company. As a notable example, Yahoo Incorporated's $1 billion cash purchase of a 40% stake in China's biggest e-commerce firm, Alibaba.com, instantly strengthened its ties to an international internet marketplace. Purchasing a company can also offer a faster, less risky, less costly option than developing products or markets in-house or expanding internationally. Amazon's strategic purchase of Whole Foods in 2017 was a move to enter the retail grocery sector. In addition to the new product market, this move offers Amazon opportunity to sell Amazon tech products in the grocery stores, as well as access to an entirely new set of data on consumers. Another motive for acquisitions is financial restructuring, cutting costs, selling off units, laying off employees, and refinancing the company to increase its value to stockholders. Financially motivated mergers are based not on the potential to achieve economies of scale, but rather on the acquirer's belief that the target has hidden value to be unlocked through restructuring. Most financially motivated mergers involve larger companies. When Facebook, now Meta, acquired Instagram for $1 billion, Instagram was a newer company that had yet to generate any revenue. Although the company had a strong customer base and a hold on the photo sharing market, they were struggling financially. The acquisition brought Instagram to the forefront, supported by the financial strength of Meta. Emerging truths. Along with the technology boom of the late 1990s, merger activity increased. This was in part due to favorable economic conditions and deregulation. Activity was centered on global expansion and mergers in the technology sector. Companies were using their stock, which had been pushed to unrealistically high levels, to buy each other. When the technology bubble burst in 2000, the level of merger activity dropped as well. It fell even further after the United States was attacked on September 11, 2001. Then, massive corporate wrongdoing began to surface. Stocks plummeted in reaction to these events, and merger transactions, which generally track stock market movements, fell as a result. Today, merger activity is once again on the rise. Propelled by a solid economy, low interest rates, good credit, rising stock prices, and stockpiles of cash, activity in mergers and acquisitions is expected to be up nearly 25% over 2024 globally. Size is definitely an advantage when competing in the global marketplace, but bigger does not always mean better in the merger business. Study results show that heady mega mergers can in fact be a bust for investors who own those shares. So companies are wise to consider their options before stuffing their dollars in the biggest merger slot machine they can find. In their eagerness to snare a deal, many buyers pay a premium that wipes out the merger's entire potential economic gain. Often managers envision grand synergies that prove illusory or unworkable, or buy a company that isn't what it seems, not fully understanding what they're getting. Integrating acquisitions is both an art and a science. Acquirers often underestimate the costs and logistical nightmare of consolidating the operations of merged companies with very different cultures. As a result, they may fail to keep key employees aboard, sales forces selling, and customers happy. Companies will always continue to seek out acquisition candidates, but the fundamental business case for merging will have to be strong. So, what should companies look for to identify mergers with a better than even chance of turning out well? A purchase price that is low enough, a 10% premium over market, as opposed to 50%, so the buyer doesn't need significant creative solutions to make the deal work. A target that is significantly smaller than the buyer, and in a business the buyer understands. The more transformational the deal, such as entering a new business arena, the bigger the risk. A buyer who pays in cash and not overinflated stock. Evidence that the deal makes both business and financial sense and isn't purely the brainchild of an empire-building CEO. Mergers are tough, culturally, commercially, and logistically. The most important quality a company can bring to a merger may be humility.
Concept check. 1. Differentiate between a merger and an acquisition. 2. What are the most common motives for corporate mergers and acquisitions? 3. Describe the different types of corporate mergers.
4.7 Trends in business ownership. Learning objectives. What current trends will affect the business organizations of the future?
As we learned earlier, an awareness of trends in the business environment is critical to business success. Many social, demographic, and economic factors affect how businesses organize. When reviewing options for starting or organizing a business or choosing a career path, consider the following trends. Baby boomers and millennials drive franchise trends. We all hear and read a great deal about the graying of America, which refers to the baby boomer generation heading toward retirement age. By 2030, the 73 million members of the baby boomer generation will be over 65, which is driving the ongoing battle to stay young, fit, and healthy. Boomers have transformed every life stage they've touched so far, and their demographic weight means that business opportunities are created wherever they go. With their interest in staying fit, boomers are contributing to the growth of fitness and weight loss franchises. This category is well represented in Entrepreneur's Franchise 500, with multiple fitness franchises on the list. And according to IHRSA, nearly 70 million Americans belong to a health club, up from previous years, so there are plenty of consumers feeding this growing trend. Another area of boomer-driven franchise growth is elder care. Founded in 1994, Home Instead Senior Care is the largest senior care franchise in the world, with a network of over 1,200 independently owned and operated franchises in several countries. And as the world's population continues to age, the need for its unique services will continue to increase. Home Instead Senior Care provides a meaningful solution for older adults who prefer to remain at home. Compared with the annual cost for a nursing home placement, over $100,000, home care can vary significantly and can be as much as $70 to $80 per hour. Quality of life is enhanced by Home Instead Senior Care's part-time, full-time, and around-the-clock services, designed for people who are capable of managing their physical needs but require some assistance and supervision. Home Instead Senior Care provides meal preparation, companionship, light housekeeping, medication reminders, incidental transportation, and errands. These services make it possible for older individuals to remain in the familiar comfort of their own homes for a longer period of time. But the best deal yet may be adult day services, a fast-growing franchise opportunity, and still one of the best-kept secrets around, according to Entrepreneur magazine. Based on the concept of daycare services for children, Sarah Adult Day Services Incorporated offers a franchising opportunity that meets the two criteria for a successful and socially responsible business: a booming demographic market with great potential for growth, and excellent elder care. Programs such as Sarah Care Centers are highly affordable for its clients, costing around $75 per day. The Sarah Care franchise allows entrepreneurs to become part of an expanding industry while restoring a sense of dignity and vibrancy to the lives of older adults. Millennials, individuals born between the early 1980s and 2000, are the largest living generation in the United States, according to Pew Research. Millennials dine out at a higher rate than the general population. They have been recognized as changing the restaurant scene by expecting digital interfaces, unique dining experiences to share on social media, and diverse menus. Recent estimates indicate that nearly 3/4 of millennials and Gen Zers are interested in entrepreneurship. Personal career fulfillment is cited as one of the primary reasons millennials want to take the entrepreneurship path. When it comes to owning a franchise, growth potential and meeting a flexible, fulfilling lifestyle are both something that attracts millennials. According to Intelligent.com, nearly half of college graduates want to start a business after graduation. However, data also indicate that graduates lack the skills necessary to be successful. Franchising is the perfect solution to these issues. For example, Chicago area native and millennial Sal Raman grew up working in his family's diner. Sal had a dream of operating his own restaurant, and he decided to take the franchising path. In 2015, at the age of 27, Sal opened his first Wing Zone store in suburban Glendale Heights, Illinois. Boomers rewrite the rules of retirement. At age 64, Malik Larson could be the poster child for retirement, except that the concept makes him recoil. Malik and his husband are living their dream in a comfortable house on the shore, where Malik kicks back by floating in the pool when he's not spoiling his grandkids with trips to Disneyland. "The only way you can get me out of here is to carry me out," Larson says, referring to the consulting company he founded and runs from his basement office. "I love my work, and I cannot imagine sitting at home and doing nothing." Larson is not alone. Today's boomers are working longer at their jobs and embracing post-retirement second careers, which often means starting their own small business. As retirees opt to go into business for themselves, they are choosing different forms of business organizations depending on their needs and goals. Some may start small consulting businesses using the simple sole proprietorship form of business organization, while couples or friends might choose to become partners in a retail or franchise venture. The more healthy and energetic the baby boomer generation remains, the more interested it is in staying active and engaged. And that may mean postponing retirement or not retiring at all. In fact, 53% of boomers plan to work in some capacity during their retirement years, and 36% indicated that they will retire past 70 years old, or not retire at all. Mergers and foreign investment boom too. Both in North America and worldwide, mergers and acquisitions are expected to continue to increase after several years of decline. These increases are expected to occur across sectors. The increase is the result of improving economic growth and better stock prices. This current boom in mergers feels different from earlier merger mania, however. New players are entering the arena, and the number of U.S. and foreign companies making cross-border acquisitions has increased. Whether these new mergers will be good for the global economy remains to be seen. Transactions that lead to cost savings, streamlined operations, and more funding for research and capital investment in new facilities will have positive effects on profitability. Many deals, however, may fail to live up to the acquirer's expectations. Foreign investment in U.S. companies has also increased dramatically. Annual foreign direct investment reached over $40 trillion in 2025. The jump is the result of a worldwide investment in advanced manufacturing and AI technologies, as well as the continued attraction of the U.S. economy to investors worldwide. And what about U.S. investment abroad? This investment, too, is increasing. According to reporting from the U.S. Department of Commerce, the outflows from the United States into other countries is now nearly $7 trillion a year. In addition to the attraction of cheap labor and resources, U.S. companies of all sizes continue to tap the intellectual capital of developing economies such as China and India, outsourcing such functions as payroll, information technology, web and email hosting, customer relationship management, and human resources to keep costs under control and enhance profitability.
Concept check. 1. What are some of the demographic trends currently impacting business in the United States? 2. As a prospective business owner, what could you do to capitalize on these trends? 3. What other economic trends are influencing today's business organizations?
Preparing for tomorrow's workplace skills. 1. Suppose you are considering 2 job offers for a computer programming position. One at a 2-year-old consulting firm with 10 employees owned by a sole proprietor, and one at a publicly traded software developer with sales of $500 million. In addition to comparing the specific job responsibilities, consider the following. Which company offers better training? Do you prefer the on-the-job training you'll get at the small company, or do you want formal training programs as well? Which position offers the chance to work on a variety of assignments? What are the opportunities for advancement? Employee benefits? What happens if the owner of the young company gets sick or decides to sell the company? Which company offers a better working environment for you? Answering these and similar questions will help you decide which job meets your particular needs. 2. Before starting your own company, you should know the legal requirements in your area. Call the appropriate city or county departments, such as licensing, health, and zoning, to find out what licenses and permits you need and any other requirements you must meet. Do the requirements vary depending on the type of company? Are there restrictions on starting a home-based business? Contact your Secretary of State or other agency that handles corporations to get information on how to incorporate. 3. Sasha Hildebrandt wants to open a business selling her handmade chocolates over the internet. Although she has some money saved and could start the business solo, she is concerned about her lack of bookkeeping and management experience. A friend knows an experienced business person seeking involvement with a startup company. As Sasha's business consultant, prepare recommendations regarding an appropriate form of business organization, outlining the issues to consider and the risks involved, supported by reasons for your suggestions. 4. You and a partner co-own Swim Clean, a successful pool supply and cleaning service. Because sales have tapered off, you want to expand your operations to another town 10 miles away. Given the high costs of expanding, you decide to sell Swim Clean franchises. The idea takes off, and soon you have 25 units throughout the region. Your success results in an invitation to speak at a local Rotary Club luncheon. Prepare a brief presentation describing how you evaluated the benefits and risks of becoming a franchisor, the problems you encountered, and how you established good working relationships with your franchisees. 5. Do you have what it takes to be a successful franchisee? Start by making a list of your interests and skills, and do a self-assessment using some of the suggestions in this chapter. Next, you need to narrow the field of thousands of different franchise systems. At the Franchise Handbook website, you'll find articles with checklists to help you thoroughly research a franchise and its industry, as well as a directory of franchise opportunities. Armed with this information, develop a questionnaire to evaluate a prospective franchise. 6. Find news of a recent merger using an online search or a business periodical such as Bloomberg Businessweek, Fortune, or the Wall Street Journal. Research the merger using a variety of sources, including the company's website and news articles. Discover the motives behind the merger, the problems facing the new entity, and the company's progress toward achieving its objectives. 7. Team activity. After pulling one too many all-nighters, you realize your college needs an on-campus coffee/food delivery service and decide this might be a good business opportunity for you and some friends. Split the class into small groups. Start by outlining the management, technical, and financial resources that are needed to start this company. Then evaluate what resources your group brings to the table and what you will need from partners. Using Exhibit 4.3 as a guide, develop a list of questions for potential partners. After each group presents its findings to the class, it should pair up with another group that seems to offer additional resources. Interview the other group's members using your questions to decide if the teams could work together and if you would proceed with this venture.
Ethics activity. After seeing a Quiznos franchise recruitment infomercial to recruit franchisees, you're tempted to apply to open your own Quiznos subshop. However, your research on the company turns up some disturbing information. Some franchisees were concerned with the company's management and practices, among them excessive food costs, lack of promised support, and selling new franchise locations that are too close to existing stores. A group of New Jersey franchisees sued Quiznos for selling them franchises but not providing locations 18 months after taking their franchise fees. Some franchise owners questioned Quiznos' purchasing tactics, choosing food and beverage suppliers based on the referral fees it receives instead of the lowest cost provider. Other franchisees have suffered major financial losses. Quiznos, which now has less than 350 locations worldwide, with around 150 in the United States, disputes the various claims. The president of the company points out that in a franchise operation, there will always be unhappy franchisees and those who can't make a success of their units. Besides, Quiznos' franchise offering materials clearly state that the company may open stores in any locations it selects. Using a web search tool, locate articles about this topic and then write responses to the following questions. Be sure to support your arguments and cite your sources. Ethical dilemma. What are Quiznos' obligations to its franchisees? Is it ethical for the company to open new franchises very close to existing units and to choose vendors based on fees to the parent company rather than the cost to franchisees?
Critical thinking case. I'm an owner of a professional sports team. Many of the richest individuals have added professional sports teams to their ownership portfolios. Paul Allen bought the Seattle Seahawks after founding Microsoft. Upon his death, the franchise passed to the Paul Allen estate. Another Microsoft alumnus, Steve Ballmer, now owns the Los Angeles Clippers. They, like most other owners of sports teams, including Shahid Khan, Jacksonville Jaguars, Jerry Jones, Dallas Cowboys, the Ricketts family, Chicago Cubs of Major League Baseball, and Jeff Molson, Montreal Canadiens of the National Hockey League, all have corporate structures that operate as for-profit organizations. There is one exception to the corporate structure, however. The Green Bay Packers are unique among North American sports teams in that they are a community-owned, not-for-profit. They do have shareholders, but the shareholders have limited rights, and most shares are bought so that fans can claim ownership and use the stock certificate as a piece of pride of ownership in a unique community treasure. The shares do not pay dividends, and any proceeds from any possible sale or liquidation of the team go to a charity, not the shareholders. This system, plus transfer restrictions and a cap on the number of shares that any single individual can own, ensures that the team remains in public hands and will never leave the city of Green Bay. Every shareholder in the Green Bay Packers received a ballot for electing the team's board of directors, who then select an executive committee of 7 individuals who will meet with Chief Executive Officer Ed Policy. Policy is charged with hiring other leadership positions, such as the general manager, who then hires the head coach, who is charged with hiring the assistant coaches. So, what are the negatives to what seems like a perfect organizational structure? Many owners in other cities are able to price their tickets to the market and also able to create revenue streams from corporate advertising in the stadium as well as stadium naming rights. The Packers have some of the lowest priced tickets in the league, despite 140,000 requests on their season ticket waiting list. Also, teams in other cities can negotiate with city, county, and other government agencies for subsidies and tax breaks for building new stadiums, and use the threat of a move to another city as a bargaining chip. For instance, the St. Louis Rams and San Diego Chargers recently moved to Los Angeles, while the Oakland Raiders now call Las Vegas home. Another potential drawback is that the organizational structure of the Packers restricts the ability to make organizational changes, such as changing the general manager or head coach quickly if things are going badly. Luckily for the Packers, this has not been much of a problem over the decades, having had success with star quarterbacks such as Aaron Rodgers. Critical thinking questions. 1. Is the not-for-profit form of business organization appropriate for the Green Bay Packers? Why or why not? 2. Why has this form of ownership not been replicated in other cities? 3. What are the limitations and constraints that this form of business has on the operations of the Green Bay Packers? This has been Introduction to Business, 2nd edition, from OpenStax. OpenStax textbooks and this free audiobook are covered under a Creative Commons license. The full text is available at www.openstax.org. You can find this free audiobook anywhere you listen to podcasts, including Spotify, YouTube, and Apple Podcasts. Instructors can even download a course shell to easily embed these recordings in Canvas courses. Learn more by visiting www.openaudio.us. Did you find this audiobook helpful? If so, please let us know by leaving a comment and sharing this recording with a colleague or a friend.